you are watching this lesson, it means you have at least heard the phrases invest in Dubai or buy a villa in Bali. And most likely, you already have your own picture of these markets. The Maldives in this list usually stands apart as a something too elite and about holidays and not investment. In this video, I want to calm me with numbers, compare this destination, Dubai, Bali, and the Maldives, and show you what role the Maldives can play in your portfolio. First, let's briefly break down this market. Dubai is a huge and already quite structured ecosystem, a lot of new projects, an active secondary market, and strong infrastructure. Average rental yields in different areas are now around 6-9% per year, and in some high-yield location you can reach 10-11. But for that, you need to choose the location very carefully and count all costs. Bali is most likely tourism and lifestyle market. The main product is villas for a short-term rent. According to industry analytics, a normal benchmark for gross yield here is 8-12% per year, and in successful cases with a high occupancy and strong management, there are properties showing 15-20% annually, but the quality of properties varies a lot. The Maldives are in completely different league. There is almost no classic housing products for foreigners here, but there is a premium resort market with a very high revenue per room. Industry reports showing that by 2025, RevPAR on Maldives resort reached around $565 per room per night, which is 3 or 4 times higher than in many popular resort destinations, including Bali and Canary Islands. Now, let's talk about the legal side, because this defines how safe you feel as investor. In Dubai, everything is as comfortable as possible for an investor. In designed areas, there is a classic freehold model. You become a full owner, you can freely sell the property, pass it on hands, use it as a collateral. Everything goes through the Dubai Land Department and is well digitalized. In Bali, a foreigner doesn't have a simply bought a land in full ownership forever option. The basic working tool is the long-term leasehold for 25-30 years with extension option registered in your name or in your company. For larger projects, the PTPMA structure is used, a foreign-owned company that can obtain development and ownership rights for the term of the lease. So in practice, the structures works, but a lot depends on how professionally the contracts are built and who you sign them with. Some older deals are still structured through the nominees, where the land is legally owned by a local resident, and there is an additional risk for the investor. The Maldives takes an interesting middle position here. The land stays with the state, but the long-term leasehold are issued for tourism project. Thanks to recent change to Tourism Act, this lease can be extended up to 99 years, so the holding period is comparable with a full life cycle of the resort. At the same time, a clear common law model is used for resorts and structure through the companies, management agreements, protection of investor rights in corporate documents, not just promises from a local lawyer. In practice, this feels much more secure than many private schemes in Bali, and at the same time quite familiar for those who have worked with the English law and resort structures. Next, where the income actually comes from. In Dubai, the average daily rate in hotels is now roundly in the $180-200 range. Industry data for 2024 shows an ADR of about 680-750 dirhams, so roundly $185-200 at high occupancy. This is the strong result for an urban destination, but it is important to understand that with this ADR level and with the new supply constantly entering the market, rental income logically gives you around 6-9% per year. And on top of that, you pay for capital growth of the specific property. In Bali, the picture is different. Hotels and villas here work more in the mid-scale to upper upscale range. Recent market reports show ADR at around $140-$160 per night across the markets and a bit higher in the prime area. Because the base level is lower and occupancy can be high, villas can deliver a growth yield of 8-12% and in the top cases up to 15-20%. But this is already the result of very precise work with the product and management. In Maldives, the logic is different. From the start, the country live on high price per night. Industry reports show ADR in the premium segment from 2023 to 2024 in the range of roughly $580 to $800, and in the part of luxury segment, it can reach $1,500 and more per night. For some ultra luxury resorts, rate can go up to $3,500. As a result, average RevPAR on the market by 2025 is around $565 per day, which is several times higher than in Bali or in mainstream city hotels in Dubai. Demand here doesn't need to be created. For 6 years, the Maldives have been receiving the world-leading destination title. The country welcomes more than 2.2 million tourists a year, and at the same time, both the average spend and the length of stay are higher than in most Asia beach destinations. At the same time, the country has a very clear limitation. There is a very little buildable land. This is not Dubai, which can expand into the desert. Every new resort is either development of a rare site or deep reconstruction of an existing project. Against this backdrop, major United Arab Emirates developers are international luxury brands are entering the market and announcing multi-billion investment into the Maldivian segment. And this is the strong signal that professional players are pricing in capital growth over the next years. If you put all of these together, the picture looks like this. Dubai remains an excellent market for those who like liquidity and capital turnover. You buy, rent out at 6-9% per year, and if needed, you can exit quickly through an active secondary market. Bali is about the lifestyle and potential high returns, but together with that, it is about a more complex jurisdiction, dependency on local partners, and in less formalized secondary market. The Maldives, on the other hand, solve a different task. They offer an entry into premium tourism with yields from around 12% in dollars based on the clear English law structure in a country with a limited land and already proven strong tourism demand. This is not a replacement for Dubai or Bali. It is the next level. You are not just adding another apartment or villa. You are adding a share in one of the most expensive and resilient resort markets in the world. Now, very important historical example. Bali and Ngurah Airport. In 2013-2014, Bali increased the capacity of its main airport. A new international terminal was built. Runway infrastructure was expanded and the number of international flights grew. The result was that tourist arrivals started to grow not linearly but in jumps. At the beginning of the 2010s, Bali received about 3.5 million tourists a year, and a few years later, they grew to more than 6 million. And in peak years, it exceeded 6.3 million tourists per year. What happens to the market? Demand for hotels and villas grew, development activity increased sharply, land prices went up, and the structure of tourism changed from exotic niche to a major international destination. In other words, infrastructure, air access, growth, the international flow, growth in real estate markets. Now let's apply this logic to the Maldives. In 2025, the Maldives reached a ceiling of around 2.2-2.3 million tourists per year. That is the current physical limit with the existing infrastructure. But after the launch of new terminal at Villana Airport, expansion of regional airports and growth in international flights, the potential of the market is in medium term is already 6, 7 million tourists per year. And here's the key, different from Bali. Tourist numbers can grow faster than the development. Why? The country is physically limited by a land, and projects are complex. The development cycle is long, environmental restructure are strict, and most islands are already allocated under leases, so supply cannot scale the fast as demand. This means a structural shortage of products, tourists are already coming, tickets are already being sold, and new high quality properties appear slowly. This is an idea environmental for investment, grow demand plus limited supply. If we look at investment portfolios smartly, Dubai is about liquidity and turnover. Bali is about aggressive yields and lifestyle, and the Maldives are about capital, stable dollar cash flow, and the premium asset. It is not an alternative, but the next level of the portfolio where an investor move for mass market into high margin tourism business. After this comparison, it becomes clear the Maldives are not a replacement for Dubai or Bali, but the next step in investment logic. But to make a balanced decision, it is important to go deeper and understand how exactly this market works from the inside. Who comes here? What type of accommodation tourists choose? How much they pay per night, which segments are overheated, and where the strongest potential is hidden. In the next lesson, we will break down the internal mechanics of the Maldives tourism market and show why the upscale segment on inhabited islands currently looks like the most rational and promising entry format for investor. See you!